Welcome to our first panel on 24/7 price feeds for tokenized assets. We're very excited to have you, and we have some great speakers, so let's get started. I'll go ahead with the introduction. My name is Erel. I'm an account manager for Flipside Crypto, an on-chain intelligence platform, and we can go across the room with introductions as well.
Awesome. My name is Tadeo. I am co-founder of Capybaras, a crypto advisory firm. And in the context of this conversation, we are essentially the users and consumers of this lovely guy's products.
I'm Niklas Kunkel. I'm the founder of Chronicle. We are one of the largest oracles, securing over 15 billion across different assets in DeFi, with a special focus on tokenized assets.
I'm Cohen. I'm Chief Legal Officer at Centrifuge. Centrifuge is probably one of the oldest sort of tokenization RWA platforms. We're mostly in the funds business right now. We've got 4 funds on the platform, about 1.3 billion in TVL AUM, and we're more of a user of your oracles rather than a producer.
Hey everyone, Marcin here, co-founder at RedStone. We are one of the fastest growing oracles on the market, supporting both push and pull model across over 100 chains, focusing mainly on what the builders need, so customizability and adaptability to what is needed on the market, which is essential also in tokenized space. Excited about the panel.
Awesome. We'll start with our first question to set the scene. As we all know, a lot of the assets that we're trying to tokenize come from the traditional markets, which have open and closed hours, versus blockchains are open 24/7, or at least they're meant to be. Do you see that as a challenge for oracles, or do you see that as an opportunity? And if you see it as a challenge, what's the core problem to solve for? And if you see it as an opportunity, do you think the industry has risen up for the occasion?
So I think it depends on what kind of asset we're talking about. I think where it becomes a problem is when we are doing let's say you have an equitive kind of derivative, right? And now markets close, and now you don't have a reference price to track, right? And so how do you price the derivative, right? There are some markets that will trade after hours for certain times, or some will even trade like over the weekend, but there's no complete 24/7 coverage. So I think in that respect, yes, it's a challenge, because your oracle model has to be like this dynamic thing where like it just uses the market as a reference during market hours, right? It might use an off-market hours trading exchange, right, that has a lower liquidity profile, right, than the main one. So you kind of have to almost like buffer potential volatility in that market, right? And then you have, when you go completely dark, right, then you have to have your own kind of model there. So I think in that respect, it can be really complex. If we're just talking about products that are just trading, right, that aren't necessarily derivatives, right, they're just a wrapper around like an existing fund, then it doesn't really matter what the oracle says in terms of price, right? It just trades at whatever it trades at, right? And I think even the idea is that eventually, right, on-chain even becomes more liquid than off-chain, right? And so you could imagine in the future, the reference for TradFi actually becomes, what something is trading at on-chain. So it's not really opportunity or challenge. It's just like very product dependent.
Great.
I mean, from the perspective of the fund company, from the perspective of the the oracle user, I would say it's probably both a challenge and an opportunity. I think in the short term, it's a challenge for the reasons, some of the reasons that Nick mentioned. You've got to be able to tie into the TradFi markets, and you've got to be able to tie your oracle into the TradFi markets in a way that's as quick and effective as possible. But at the moment, what we're faced with is still a regulatory requirement to use a fund administrator to calculate the NAV for our funds. So what the Oracle is providing is sort of a second layer of information, but it isn't the single source of truth, which is what it should be in the end. So in some future state, this is why I think it's an opportunity. In some future state, there will be an Oracle provider that will go get a fund admin license in, say, the Cayman Islands, and be able to then take on both roles, and it will align to a single source of truth, rather than having both a fund administrator calculating the NAV and an Oracle providing a more real-time update to the information. The fund administrators are, these are very not technology savvy companies in any way, shape, or form. So it should be an opportunity for someone to step in and disintermediate them, or do their job a lot better than they do it themselves, which shouldn't be too difficult.
We're here.
From my perspective, it's a challenge and no questions asked, because we have dichotomy right now between what's on-chain, what's off-chain. But it's a good problem to have, because it's an opportunity. Like whenever you create a startup, a product, the first question many people ask, what problem you solve, right? So we have a problem over here, so there should be a solution. We've seen many cases where it blew up. For example, a big problem was in March of 23 when USDC depegged because of Silicon Valley Bank going bankrupt. Then we did see this dislocation that on Friday afternoon, when markets are closed, there is no liquidity movement in traditional markets, and on-chain people are trading all the time. They feel fear. They want to react somehow to the market events. It was literally the same situation on 10th of October. I still try to understand why Trump announced, what he announced on Friday at 5 p.m., let's call it, right? Which makes US markets already closed, Asia waking up on Saturday, and Europe being already like asleep. Then the only liquid market is crypto. And if someone has a diverse portfolio in TradFi and crypto, then actually this is the only source of liquidity that you can exit. That's the reason there was such a huge drop in value. And then also the oracles played a big role over there. I can go into that in a moment. But how to solve that challenge? I believe it's mainly coordination between the fund admins, oracles. Then you have a question what an oracle is. Should an oracle be a fund admin, or should it be just a delivery layer? That's a question depending on the asset that is being delivered in question. And if the value over the weekend should be updated or it should be snoozed. An example, right now we're an oracle for HIP-free markets on Hyperliquid, which is permissionless perpetual markets. We deliver Tesla stock price feeds. And throughout the week, it's fairly simple because you have a liquid market. Even after afternoons during the week, there is a pretty decent market over that. But when you look into the weekend trades, the liquidity dries and the volume is very, very low, very thin. Should you allow people trading over that market? And what happens if a big Tesla factory in China blows up on Saturday and people want to exit their positions? Those are the questions that we are right now trying to figure out with the consumer of the Oracle, because at the end of the day at RedStone, our stance is that we create a product by builders for builders. So it doesn't matter how you are going to design it. It matters how the other party is going to consume it, understand it, and then configure their markets based on that. So I believe, to sum it up, the most important question is, as we are transitioning from only off-chain to right now the world where there is on-chain and off-chain, to coordinate with the consumers of that kind of data, understanding what's going to happen in the stress test environments.
Great. So far I've heard 2 challenges and 1 opportunity. I think you'll be the tiebreaker.
I think it's still a challenge, mostly because DeFi is adapting to the, let's say, the limitations of the traditional markets. And until Travet does start trading 24/7, you have an asset that is liquid at one point and illiquid in the following hours. So having to manage that, and more than anything, is more interpreted. I think the issue is, we used to have an issue with oracles where they need to be built for the context of where the token, the tokenized version of the derivative version of it had its peculiarities, let's say. Now it's also very much the context of the underlying itself. And also the presumption of users that anything that is tokenized is inherently liquid, which is not the case. So I've actually been able to marry those two things together. And also, just I think it's a user education process. I think you can get the Oracle pricing all day long, but if you don't understand how the price is constructed or how the price will react, let's say with off market hours, it's still an unfit product for that user.
Yep. Marcin mentioned a good point. He said that at the end of the day, consumers choose how to use the Oracle. What does this panel think about who is the responsible party to give the guidance to the consumers on the best practices to use these oracles? Is it the provider? Is it the issuer? Is it the community? Any opinions?
I mean, I think it depends a lot on the product. I think that for a regulated product like the funds that we have on our platform, the issuers have to work with the oracles. It's going to be an issuer oracle question, and then the investors decide whether they like the way that was organized, and they decide whether or not to invest on the basis of what the issuer and the oracle provider have come to a conclusion for. But I mean, obviously, if you've got perpetuals on Hyperliquid, that's a very different situation than a regulated fund company. So, I think it's going to be an iterative process always, where there's a tech side of it, there's a product side of it, there's a legal side of it if you're a regulated fund company. So, there's a number of different things that you need to take into account.
Yeah, I would echo Eli's sentiment, and we work quite closely with Centrifuge. I would say the problem is mainly a people problem and not a technology problem. When you're talking about a particular tokenized asset, I think people just kind of see the headline of like Centrifuge just launched whatever, or BlackRock just launched blah. What you don't see behind that headline is that there is a fund admin, there is an asset manager, there's the tokenization like issuer platform, there's an oracle, there's potentially a chain DeFi credit protocol, there's an oracle, right? So there's all of these different players, right, that have to come together to tokenize this thing and then get it embedded into like the fabric of DeFi, right? And I forgot to mention, there's also like an allocator, right? Someone has to put actual money into this thing, right? Actually, they're probably the most important one in this food chain. So from an Oracle perspective, it's okay. Well, we have to look at what the particular product is and come up like with a model. Okay, how should this thing be priced, or what other contextual data is important here? Then you have to go to either the tokenization platform, or even better is kind of the custodian or the fund admin, right? To say like, hey, can we get this data, and are we legally allowed to like distribute this data? And a lot of times they'll come back with and say, well, we can give you this data, but not that data, right? And so then it becomes like this tug of war match of like, well, how much leverage can, say, the asset manager or the tokenization platform put on, the custodian or the fund admin or whoever, right? To say like, no, like we need this data, right? Because without it, you can't create a good Oracle model, and without that, right, you're not going to get the integration into DeFi, right, which is going to be like your main avenue of distribution, right? So it's really not a technology problem. It's really just a lot of like wrestling everyone in the zoo, like to like, or more like a school of fish to get everyone to like swim in the same direction.
Yeah, I would say I think the user is at fault. I think the user has to be the ultimate critic, and what the user demands is what the market will eventually be providing. I think our industry has let's say, I think it's like a very FOMO-induced user base that basically consumes anything that's being created or being available in the market, rather than being a strong critic and demanding certain guarantees or actual let's say, quality of life features of products. So if we've recently had a major blowout of a fund that was just showing very high APYs, for example, with essentially hard-coded oracles all around credit markets. If the user would be critic and wouldn't be there, it would be a non-issue. I think we're entering that level of continuing that level of euphoria of every new opportunity is a better opportunity than what we currently have available.
Marcin, any thoughts?
Well, tokenization is very broad. Like when we were talking about just putting from fund admin like an 24-hour NAV on chain, like there's probably not that many edge cases that you can hit. Of course, there are some, but not like crazy amount. It's different when you tokenize a stock that, again, is traded and is very volatile. And it's also very different when you put on chain a tokenized version of a fund where you have allocation, a couple of products. For example, 50% going to T-bills, 20% going to private credit, 20% going somewhere else like cash and carry and so on. In that case, proof of reserves are extremely important. And then the understanding on the issuer side is the most critical. The allocator, of course, is very important, but the allocators many times, at least from my understanding and experience, is they don't fully understand what's happening over there. Like they just try. They have a contract many of the times, and for them, and this is something that crypto has to embrace. I believe we need to have more contracts. We need to have more legally binding aspects.
Eli, your job is
Eli seems to disagree.
I believe, depending, of course, on the context, but 3 years ago, people were not signing any contracts. Right now, we sign more and more. I'm not saying to contractualize every single bit, but I do believe there has to be more liability towards people that are doing the job over there. We are grown-ups. We are not frogs on Twitter anymore, like anons writing like funny posts and memes only. If you want to grow up to the industry that is that is considered a parallel environment to the TradFi, we just have to live up to the standards, right? Like this is also one of the reasons we purchased Credora as the DeFi ratings platform, because ratings is something that is expected or sometimes even required in TradFi in order for some people to allocate into specific fund or like strategy. So to put it all together, it really depends on the tokenized asset. But if you're talking about funds and on the proof of reserve side, it's also attesting on multiple accounts that are delivering that. I'm not sure how it's coordinated on Centrifuge side, if it's just like one fund admin or there is like a case where you have a couple of parties where you allocate the funds and they have to reconciliate from multiple places. But then it's also important to understand whether the person that is delivering you the data is legally obliged to deliver something that is accurate, right? Because otherwise it is like a signature from the attester coming from the first place, for example.
Yeah, I agree. I do agree with you that we do need more contracts. I don't welcome that, but I do agree that we do. I think there's another important player, especially for markets that are linked into the TradFi, is there are a few really important index providers in the TradFi markets who very much jealously guard their data. Their whole we've launched an S&P 500 tracker fund, tokenized tracker fund. That was a 6 to 8 month negotiation with S&P to get their data feed. Their whole business model is just data. So, that they take that very seriously, and they take the licenses that they provide, the distribution licenses for their data very seriously, and they will be very, very, very careful about who they allow to have access to their data. And if you don't have the license, you don't get the accurate data, because they can make a change to the index and other people don't catch up for a few days or weeks or months or years. So it's really important to get if you want accurate data, you really need to get a license from the data distribution providers for an index fund.
So the sentiment I'm hearing is if institutions are coming, we should be ready for them. That's what I'm mostly hearing.
I just want to add on to kind of what Eli said, and also Marcin, you touched on this earlier, right? Oracles are a data information layer, right? They don't do magic. If the data that's coming in is garbage, what the Oracle is going to report will also be garbage. And so I think especially on the tokenized asset side, right? I don't think TradFi has necessarily matured enough to understand like the downstream effects of when they are providing data that it can have on a tokenization platform, but especially on an Oracle and subsequently on some kind of DeFi credit platform. We very frequently, like fund admins will, the canonical ledger, the canonical source of data for them is a spreadsheet, right? So they do end of day like fund accounting, right? And what you're going to get is a spreadsheet. And maybe one day the format of the spreadsheet completely changes. Or one day, someone just the order of magnitude is off by 6, right? There's just 6 extra zeros in like a bunch of different fields, right? And that can be catastrophic, right? From an Oracle like data reporting point of view, that can be catastrophic for a DeFi protocol, right? That has some kind of credit looping strategy using this tokenized asset, using this Oracle, right? And I don't think that a lot of the institutions are really at the maturity level where they really stand by the data that they report, and trying to nail them down and get them to contractually agree to provide data in a guaranteed capacity and not in a informational only, we're not liable capacity is a real struggle. And I hope is something that gets resolved relatively soon, because otherwise we're going to see some blowups in DeFi. And I hope this is not one of those instances where DeFi doesn't get its shit together until something goes wrong.
No, I think it's more the question of the TradFi players not getting their shit together. I mean, I think it's the people here on the stage that are going to drive the innovation into the TradFi markets in the fund industry more than the other way around. It's the TradFi players that, as Nick says, are way too slow to manage in a DeFi kind of environment. And way too the technology is completely backwards. 20 years old technology that they're using, and things can definitely blow up. I think it's going to be the Oracle providers that are going to actually take over that whole function, at some point, and we'll have a much better industry. But that's going to be some time coming, and there's going to be some risk between now and then. Yeah, it's important to have the contracts, but it's also important what is in the contracts and what they say.
Cool. Any other thoughts? Great.
I don't think it's the oracles are at fault on this, but we currently have tokenized real assets, real estate tokenized assets being leveraged on a viral lending market. There's no good enough price. You can't have a single person just actually putting a price on the building every single day. That makes sense to have that asset as collateral in that environment. Part of the innovation, and again, it's just stumbling until you get up and you actually don't fall again, is eventually going to be seeing this catastrophic situations we're going to have. We're going to have it with more other tokenized assets that have the most amazing Oracle price and beautifully constructed. They're just being put in the wrong context. And unfortunately, I think investors and token holders are going to get burned because of that.
Cool. I had a question for Marcin. I know you mentioned Credora going from price feeds to a more proactive risk intelligence. What's driving that momentum for you, and how has the institutions you've been working with been receiving the concept of on-chain risk intelligence?
$92 million haul is what Stream Finance reported a couple of weeks ago. And this is one of the things that we tried to omit with Credora to happen again on the market. Ratings is not the silver bullet. It's not that people are not going to ape into a new strategy, but we've analyzed how usually these kind of products work, and the cycle is very, very similar each of the time. There's a new product that is, let's call it synthetic yield-bearing stablecoin. Then the founder and family and friends put in a couple of $1 million, let's call it 15. So there's like initial seeding. Then the apes in the crypto industry, so people who search for high yield, high risk opportunities early on to get an airdrop or whatever, put in, let's call it another $20, $25 million in there. You end up having $40 million. Then you have those people that are already in trenches in crypto, are looking for new interesting opportunities to invest, but they don't look at anything below, let's call it $30 million or $40 million mark. So you already got this 40 million. So they're like, okay, social proof, other invested, so I can invest as well. And then you end up having 100 million. And I believe, as I talk with people on conferences, $100 million is this kind of like a magical barrier that someone thinks, okay, if all the market is confident enough about this product to put 100 million in, if I'm going to put my $50,000, it's going to be fine, right? Like, bro, right? And then it turns out not necessarily. So this is a kind of a cycle we want to break with the rating, because the moment you have this initial seeding from the creator of an asset, you can already create a rating that is dynamically verified. Right now, it's, I believe, every week, and we want to shorten the period every 24 hours because it's like an engine. It's not like an analyst just looking into that. It's like a formula, a quant methodology that is assessing based on the number of audits, the liquidity provision, what is the slippage on DEXs. So there's a multiple factors that we put into the formula that we got from Credora when we acquired the company. And then imagine this product, for example, Stream. It's very hard to give a rating to a product that already blew up, right? Like in the hindsight, everyone can say, hey, this is like a Z, like it's an investable, right? But we did try to do an analysis, and most likely it would get like a C or maybe even lower. Like C, C minus, D is the lowest in our methodology. So the fundamentals over there were broken. So if you were to signal that early on, when only the creator did put money in, the apes, okay, maybe they would put in, but as you go on the scale to the more risk-aware people, if they see, hey, this is a C, and then you have a toggle that you can put your cursor on, and then you learn it's a C because of lacking transparency, because funds are reinvested, and it's like, I don't know how to call it in English, Ouroboros. So, you know, like this snake that is essentially eating its own tail.
Like
rehypothecation, right? And like you're reinvesting just to pump up your TVL, and then again to attract more and more people. This is exactly the cycle we want to break with Credora, so that, okay, the apes will ape, but the regular people are not going to get burned, because this is the worst thing that we can do for institutions to be hesitant to go into the space. Because on one side, they see BlackRock, Larry Fink talking about Bitcoin and all the, you know, Stripe, Revolut, Robinhood, big companies going there. And on this other, they see those people that are creating wrecked product and, you know, $100 million evaporating like this without anyone watching over that. So this is a kind of logic we followed with Credora. And the reason we acquired them, there are two major ones. The first one, we have the data. We're an Oracle company, so we gather the data. In order to create a reliable rating that is updated regularly, you need the data to put into the engine. As Nick well positioned, garbage in, garbage out. But if you have good data in, then you can have something insightful out. And then we already worked with those projects. Morpho, Compound, Spark, Fluid, Euler, and so on. For all of those are consuming RedStone data. So right now we can very easily convey to them the message, hey, this is a product that we oversee. You've seen our quality of the work. We've never had a single mispricing or like downtime event as RedStone. So we can put our mouth on that product as well. And for sure, there are going to be controversies. There are going to be probably products that we are going to rate B+ and are going to blow up. So it's not like a remedy for everything, but it's going to bring up more conversation as well, because there's going to be an issuer that is going to get a C. And this issuer is going to come to us say, hey, you're stupid, like you give me C. And then we tell them, all right, but you have low transparency and again, those factors. And this guy either is going to improve on those metrics or is going to keep having C. And then the market is going to observe that and acknowledge and maybe put assets into something else. So we're going to have it displayed on Morpho and Spark this and next week. So as people go to Morpho, not only they're going to see, for example, 10% yield, but on the vault, they're going to see, let's call it B rating. And another vault is going to be 8% and A plus rating. And then it's up to you. Like if you want to still go for B and 10%, that's fine. But then you have just more informative choice. And there is less probability of people going after social proof and where people just, throw money without necessarily thinking about it. So I believe it's going to be also important for institutions as they see that we mature, and S&P is already rated MakerDAO. I know Charles is going to be around, and I believe they should also go for the biggest assets, because this is how we uplift the standard of the game. Because then no more you can say just, okay, trust me, bro, pinky promise. No, you're going to be called out if you're doing something that is not according to the standard, and either you improve like progressively, or you're going to be left out because others are going to do the proper job. To give an example over here, Etina, of course, is like pretty controversial in the sense, hey, is it a stable coin or not? It's like more like a hedge fund receipt token, right? Or you can call it synthetic stablecoin, if you will. It's definitely not the same risk as USDC, but I do believe Etina is doing a fantastic job in terms of transparency, like going after the standards, because it's novel, it's something new, but they're doing the good job to keep the standard fairly high.
Great answer. I love it. Bringing accountability on chain.
I mean, we S&P is also rated our treasury fund and Moody's in particular. So yeah, I mean, we're very much, I think that's a different kind of rating mechanism than what you're talking about with Credora. But I think that's that's a great step forward.
So Particular is looking more on a single asset, and Credora is more focused on the final strategy, because usually when you allocate into a specific asset and you go into on-chain, one of the reasons can be distribution to the global audience and all the goodies that come with blockchain. But one important one is composability. So if you want to put that asset into work in DeFi, usually you have the other asset over there. So for example, tokenized fund from Centrifuge and USDC, or it can be USDE. And these two markets can live on Morpho, and both of them can have a different Credora rating because you have different exposure. On one side, you have, let's call it A+ grade Centrifuge asset, but on the other, you have a different stablecoin. And some people might want to do this kind of a mix, like using tokenized asset and then more aggressive stablecoin that gives yield, because they have trust, because they want to have that kind of a strategy.
Great. And I wanted to ask Nick, when we think about proof of asset that Chronicle launched, do you see that as a complement to proactive risk management?
Absolutely. I think, right, I touched on earlier, right, that the role that oracles play, right, is really to take like the output of like these guys, right? So Centrifuge has tokenized something. It's like, okay, but just tokenizing something is not enough, right? It's just, congratulations, it's tokenized now. But really to get it integrated into DeFi, right? Right now we're doing the bare minimum, right? The bare minimum is, here is how you price this thing. And so now, right, you can generate credit against it. And I think it's quite complementary to what Marcin just touched on, right? Ratings is definitely one element, right, to kind of inform consumers. But I think the role of oracles is changing substantially with the advent of tokenization. I think what you called like risk intelligence, I think is going to evolve substantially. I think when you have a credit market like a Morpho or a Spark or a Maker or an Aave, they're not just going to use prices anymore. You need something like a proof of asset oracle, which gives you all of this contextualized metadata surrounding the underlying asset, right? And this is how a credit market can then protect itself, right? Because if there's ever any ambiguity in the reserves, right, it can like pause that market, or it can, dynamically adjust the amount of leverage it offers on a particular market. Or it can decide to just, this is the emergency scenario. We're going to like unwind this entire market, or, we have a emergency plan A of how to, in an orderly fashion, unwind this market, right? So the risk management of DeFi needs to evolve substantially, and oracles need to evolve to provide the inputs for these risk management kind of, you can almost think of them as like circuit breakers, or kind of like pathing scenarios, right? So I think that's going to be critical, right? Again, right, it's one of those things that like needs to happen in lockstep, right? Like the issuers need to put pressure, or the oracles need to put pressure on both like the issuers, the fund admins, right? Need to put pressure on the DeFi protocols, right? And the DeFi protocols in turn, right? Risk is like their game, right? Unfortunately, they get distracted by growth sometimes, and then something blows up, like what happened the last couple of weeks, and then everyone's very concerned about risk again for the next month. So we have like a 1 month window to go and like scare the crap out of Paul and Sam, right? Now that they're very risk conscious, right? To really eke out the bandwidth, right, on the roadmap, right? To really evolve these risk systems. But I think proof of asset, which we released like in January this year, and is now securing almost like $5.5 billion in tokenized assets, is part of the solution for that. It's more than just a proof of reserve. You're not just getting a check mark of like, is it fully backed or is it not? You're getting, in some cases, a profile of the like liquidity, right? So you can imagine like a money market fund, right, has like a bunch of T-bills, right, and maybe some overnight repos. They're not uniformly distributed maturity, right? So it's not just like every 3 or 4 days you have a T-bill mature, right? And so you get like pockets, right? Or where, there's like a drop in liquidity. And so if you wanted to like redeem a substantial portion of a fund, like say like 20% of a fund, that liquidity now becomes a problem, right? If you want an example of like how badly something like this can go wrong, look at like Silicon Valley Bank. That wasn't a problem of reserves, right? Silicon Valley Bank had more reserves than liability. The problem was they had a liquidity crunch, right? In that their reserves, these T-bills were maturing at some future point, right? And so they needed, in order to cover their liabilities with the bank run, right, they needed to prematurely sell off these reserves at a loss, right? And that's what ultimately caused that cascading failure, right? And so, this is just one example, right, of like extra data that you're going to need for a tokenized asset. And I even think that this is just something on like the product side. When you guys are considering like what is an attractive like fund to tokenize, to bring to market, right? What are DeFi people going to be interested in, or what are allocators going to be interested in, right? It's no surprise that money market funds were like the initial one that everyone was interested in, right? Rates were at 5%. It's basically risk-free. This is a super attractive vehicle. But now rates are dropping, right? T-bills are not yielding 5% anymore, nowhere close. The trend is going to continue downward, right? And so consequently, right, issuers have been looking to issue higher yielding products, right, to serve that demand for higher yield, right? So they're issuing CLOs, they're issuing private credit products, but those aren't as liquid as the money market funds. And in crypto, we're very used to like having instant liquidity, right? You can just pop in and out of a Aave or Morpho or a Spark or an Euler lending market, right? You can redeem, you can repay your DAI loan and like get back your ETH collateral. this is not going to be possible with these CLOs and private credit funds, right? They have a very, very different liquidity profile and kind of like redemption scheme. And so I think it's going to be really interesting on the structured product side is how you blend, for like a particular vault strategy, you blend the money market fund primitive with the CLO primitive, with the private credit fund primitive to create a product that, maybe is not as liquid as a money market fund, but it's higher yielding and it's more liquid than the private credit or CLO counterpart, right? And this is where the risk management systems and in particular, on the Oracle side, proof of asset is really going to come into play.
It's pretty hard to create a fund with a whole range of different assets with a mismatch of redemption cycles or potential redemption cycles in some cases, if you're talking about the private credit. So, but yeah, I mean, ideally that's what we could do, but it's not. It's a challenge.
Great. Any quick closing remarks from our great panelists?
Echoing back to the challenge of the Oracle providers, they used to provide or surface price level data. Now they need to be providing much more contextual data for users. Get to work.
We're on it.
Amen.
Awesome. Well, thanks for joining us today. And everyone have a great rest of your weekend. Thank you to our great panelists.
Thank you.